Today is our topic of discussion is return of income, return of investment, or known as ROI. So ROI is a quite famous performance measure applied by many organizations worldwide. Uh, it's in the year 1920, and a deep DuPont, an American company, found to need to consider the level of income an organization generating from the asset it has employed. So it is generally at that point the requirement of this specific thing is noticed. So it's basically the income of an organization is divided by the total assets. But this measurement changes from organization to organizations, and many organizations treat as income as a after tax, many treat it as a in net profit. Otherwise, and many organization investment is total asset, while some organization believe it's a total assets minus liabilities. But in general, in most of the cases, it is income, which is operating income, and investment is equal to total assets. So I know it's very hard, it's quite ambiguous that what is the and how it will be interpreted. So I'll take an example. So I taken a hotel branch, the hotel industry example is a inn hotel, and it has a three hotels. One is a San Francisco hotel, one is a Chicago hotel, and one is a New Orleans hotel. So for example, for measurement, we can take that the hotel revenue from the San Francisco hotel is 1 lakh 1 million 1.2 millions, while in the Chicago hotel it's 1.4 millions. New Orleans hotels is 3.185 millions, and the hotel's variable cost are 310k, 375k, or 995k. Hotel fixed cost is 650k, 725k, or 1 million, 1.68 millions of the fixed cost. So after deducting this, we get the operating income. The operating income of the San Francisco hotel is 240k, Chicago hotel is 300k, and New Orleans hotel is 510k. So now we calculate the net income. Net income is generally contributed as this is the operating income, and we will require this only in this example. So net cost of the long-term debt is this, income before this, and the income tax at the 30% deducted at this point, and the net income we get is 420k. So now we calculate the net asset or the total asset which we are using as a denominator. The current assets is equal to 400k. Chicago hotel is 500k, and the New Orleans hotel is 660k. Long-term assets is 600k. 1.5 millions of the Chicago hotel and 2.34 millions are for the New Orleans hotels. Total assets are these, and the current liabilities are these. So total assets we are taking like these, and the hotel operating income are these. So to calculate the return of income, we will use the formula which is income divided by investment. So operating income divided by the total asset. So for the San Francisco hotel, we will use that the 240k divided by total assets of 1 million, we got the 24% of the return of investment. Chicago hotel, we will get 300 k of operating income divided by 2 millions of total assets is equal to 15%. So New Orleans is equal to 500k divided by total assets of 3 millions. It's a ROI of 17%. So actually, what we interpret that the how much income the total assets are generating. So for in this case, we can easily say that this San Francisco hotel is generating more operating income on its total asset. But there is one other method in which we can interpret this thing, this return of income ratio. We can divide it into two parts. One is income divided by investment. We can easily interpret the income divided by revenue into a revenue divided by my investment. So for example, we will take this example only. So San Francisco operating income is equal to 240k, which is total assets of 1 million. So while let's take the example that the revenue of the organization, so revenues are these. San Francisco is equal to 1.2 million. So we will take that the operating income divided by revenue is equal to 20%. The revenue divided by total assets is equal to 1.2. So it interprets the 24%, which is same as the above weighting. But let me take an example that we interpret that the total asset the organization, we will reduce total investment in the organization in the hotel industry, the San Francisco hotel, we reduced by 200k. So what is the impact? What guess what will happen? Actually, when the numerator is high than the denominator, then the percentage will increase, and when the denominator is high, then the percentage will decrease. So in this case we can easily see that as soon as the total asset decrease, the total revenue divided by total assets is 1.5k. So the ROI increased, then jumped by 24 to 30%. We can interpret it by applying a similar method by the B section. For example, if we increase the revenue by higher cost, so operating income is 3 lakh in case of which organization? Chicago hotel. So Chicago hotel's operating income is 300k and the revenues are 1.5 millions. Total assets are 1 million. So the operating income is equal to 300k divided by 1.5 millions is equal to 20%, and the revenue to assets is equal to 1.5 millions divided by total assets is equal to 1.5. So the calculations of the multiply of these reach us to the 30%. But what we did is we reduce the revenue. So in case we reduce the revenue, but if we reduce the revenue, but so the operating income divided by revenue is also so the operating income divided by revenue, so we we sold a less amount, but we generated the equal profit as we did earlier. So the operating income divided by revenue, so operating net profit or operating profit ratio is 25%, while the revenue divided by assets is equal to 1.2. So the we got the similar operating income divided by total assets, so we get the 30%, which is similar to the earlier ones. So that's the topic for today. If you have any query, you can ask me in comment section, and thanks for listening. Please like, do and subscribe. Thank you.